battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name's Nick Stenger. We are Stenger Family Office. For the past 45 years, if you can believe it, it's been our family's mission to deliver you clarity and confidence to help secure your financial future. We are back at it. Let Not Your Heart Be Troubled, episode 219, S&P 7,000. Yes, the S&P actually did briefly hit 7,000 a few weeks ago, earlier in the year. However, it did not close at that amount for a few days. So I wanted to wait until the S&P actually did officially close over 7,000 for a couple of days consistently. And that's exactly where we are today. As of this morning, the market was up about 1%, a little over 1%. We have just absolutely rallied off the bottom that we saw here the past couple weeks with the Iran news. And what do we tell you? We tell you tomorrow's news today here on the show. We told you to stay on your plan. And I hope for everybody watching who's newer with us, I hope that this has been your first go around and lesson of learning. Just stay on your plan. For all of our people who have been with us for years and years and years now, for decades, we get very few calls from you because you've seen this before. You've been around and you've seen these corrections and these pullbacks. You saw 08 and 09. You saw the tech bubble. You saw 87 in some cases. A lot of you saw Brexit and Grexit and COVID and the tariffs even last year with Liberation Day. And so this is not new to you. But for the new folks, this has been your first experience really seeing how quickly the market can go down, but also how quickly it can come back. And that's exactly what Tom Lee pointed out as well, that every single waterfall correction on record has been followed by a V-shaped recovery, meaning when the market goes down quickly, it tends to come back very quickly too. It seems tough in the moment. It was like last year during Liberation Day. Remember, we dropped 19% in a matter of a couple weeks. April 7th was the bottom of the market in 2025. And all the strategists on Wall Street cut their targets. I understand why they cut, because they were worried. They didn't think there was any way we could possibly climb the wall of worry that the market always climbs and get back to a record all-time high. But what did we do at Stenger Family Office? We kept you on your plan. We did not cut our forecast last year on the S&P. And actually, we were a little under where the S&P ended up, about 100 points under. And we'll see where this year goes, too. A lot of baseball left to play here. It's only April, which is going very quickly. We're going to get into some earnings here as we go. But the earnings coming out on S&P companies, what do I always tell you? The earnings tell you where the market's going. The earnings largely have been positive. So that's the whole point of what the market does. The market digests bad news. The U.S. economy has been extremely resilient. We went into this thing with some of the lowest cost gas and energy in the world, and we're just slightly off of those lows, and we're going to get back to a more normalized level at some point here in the near future. But regardless, the U.S. economy is proven to be incredibly, incredibly resilient, actually more resilient than a lot of other places in the world. That's why we told you, stay in your tried and true U.S. blue chip companies. It's not that a country or continent once in a while couldn't get a pop. You could see some places in Europe do well once in a while, some places in Latin America do well, but we're trying to give you consistency over time and build you a long-term goals-based plan. And this is where it's been, right here in the U.S. blue chip large cap companies. Now, I want to throw two charts on the screen. I'm going to start with just what we showed you, being that I want to start with our target and our forecast on the S&P for 2026 that we always provide you with at the end of the previous year. So this was December 22nd of 2025 last year, and we said that we thought the S&P with $351 of forward earnings multiplied by about 22 PE would place the S&P right around 77.22. I'm sure you were wondering how that would be possible when the S&P was 63.54 like it was just a few weeks ago. Remember, we had a 9.5% pullback down to 6,300 or so on the S&P. And that's when the strategists tend to cut their estimates. They tend to panic and get nervous and say, there's no way we're going to get to 7,700. Well, what did we do? Once again, just like last year, we kept you on your plan, and that's been the consistent theme and message at Stenger Family Office. And we said 77.22, we're not going to change it. So here we are today. We're at 7,100 on the S&P, only 600 points off where we think the market is going for the rest of the year, which is now about an 8.5% return, and we still have about 8 months left to go this year. absolutely incredible. This is why you can't panic. So what do we tell you every single week on the show? Don't panic. Don't try to time this thing. Get yourself the golden retriever puppy. Do something else. Could end up being the best financial advice you ever get is just ignore the day-to-day market movements. Find a new hobby. And what happens over time is these companies prove to be incredibly resilient. Now, the big tech wave that's going on today is AI, machine learning, cloud computing, everything that you hear about. But I want to just take a step back from the AI buzzword for a second and talk a little bit more about what's actually happening at companies. What people don't realize is a lot of legacy Fortune 500 companies, S&P 500 companies, even the global companies out there, small caps, mid caps, are leveraging technology like never before, but it's not necessarily the stuff that you hear about in the press. It's just the basics. Half of these companies aren't even on the cloud yet. They're still using on-premise data. They're still using on-premise servers. They have not even migrated into some of the basics that have been out for 10 or 15 years. So forget the new technology. A lot of corporations haven't even done the basics yet. And you're going to start seeing more and more of this where you didn't think it was possible for a company to post 12, 14, 15, 16% earnings growth. And that's exactly what I think we're going to see here the next couple months as you see quarterly earnings come out. And you saw this from JP Morgan. Now, JP Morgan stock was a little bit flat on the news. Not a huge reaction initially, but it's coming back significantly now. And JP Morgan came out with earnings growth that was just shocking. I thought they'd grow earnings, just not as much as they did. You saw it at Morgan Stanley. You saw it at Goldman Sachs. You're seeing it at Robinhood. You're seeing it at all these corporations posting double-digit earnings growth. And it's not necessarily the companies that you would think of, the tech companies themselves in all cases, although the tech companies are doing well. It's the companies that are leveraging the technology. It's financial services. You're starting to see healthcare finally come back a little bit this year. Industrials are having an incredible year. Why? Because companies are learning how to do more with less. And they're learning how to get better and better and more efficient. And at the same time, yes, employment has ticked up just a bit, but it has not been the all-out employment abyss and layoffs that people thought. There have been layoffs. We've absolutely seen layoffs, and it's been a little bit more normalized. We were at basically record low layoffs last year coming out of COVID. Everything was a little bit distorted. But now, as we sit here today, unemployment is climbing back to a more normalized level, but it still isn't the abyss that people thought. The consumer has still proven to be pretty resilient. Wages have still gone up to a decent degree. Millennials now have actually eclipsed baby boomers on an inflation-adjusted basis at this average age that they are at, which is absolutely opposite of the narrative you hear. You hear that it's just terrible and awful everywhere. That's just not the case. Our tax business, Stenger Tax, we file almost 1,000 returns every year, and we see the kinds of incomes that people are making, and it would just astound you. I mean, it's just absolutely incredible, the kind of wealth that is out there. And there's actually another stat that the Wall Street Journal produced, that there's a record number of people in the United States with over $40 million in net worth, record people over $20 million in net worth. It's just absolutely insane, the kind of wealth that's been created. And it's all been created, for the most part, by the stock market the past 10, 15, 20 years. And so I think you're going to see this trend continue. We have very reasonable tax rates, reasonable regulation. A lot of the environment, the soil, if you want to think about the economy as a garden, the soil that you would need to have a thriving economy is still intact. And so despite having blue presidents or red presidents and geopolitical conflict and having all these different changes that have happened, whether it's politically or economically the past couple of years, it's like Peter Lynch said, and we talked about this quote last week, you spend 15 minutes on economics, you've wasted 12 minutes. Because none of it is going to help you predict the future of where markets are going, because the markets, stocks, companies, ownership in real equities, remember, equities are a claim on real assets. Equities are disconnected from the economy. The economy, when we get economic news that finally breaks, that's telling you what happened yesterday, last quarter, last month, but companies tell you what's coming. They're telling you what the future is going to look like. And so if you pair company profits, which again, we're still just getting early results now on Q1, we're going to get a ton of companies reporting next month as well. Once you start to get earnings and you see how companies are doing, they're going to tell you what the future looks like. And so when we do our due diligence process, at Stenger Family Office, we go through this extensive due diligence, hundreds of hours of research every year, meeting with 30-plus outside asset managers and economists and researchers and all the rest of it to get an idea of what people are thinking. As we listen to these earnings calls, for example, as well, we get a sense from corporations that, hey, we've managed pretty conservatively, especially the large caps. We've managed pretty conservatively. We've got cash. We think a rainy day is coming at some point, so we're going to be okay. But then when the analysts ask questions like, how are your consumers doing? The CEOs and the management teams, for the most part, are very positive. They're saying that the consumer is doing well. They've been surprised. And so if you have a really good corporate team, you have a really good management team, they're doing two things. One, they're still trying to grow. They're understanding their consumer better than anybody else. But at the same time, they're also managing risk properly. And so that's the kind of company that we're looking for. We're looking for companies doing both of those things. And so they might have a bad quarter once in a while, like Netflix once in a while has a bad quarter. But over the long run, if they're doing the right things, the company's going to work out. It's going to be okay. And that's why you just can't panic. You have no idea what the future holds. You have no idea what new technology is going to come out. You have no idea what companies are going to do. You have no idea what mergers and acquisitions and buybacks and dividends and all the things that go into a great return on a stock. You have no idea what's going to happen. And because of that, it's almost impossible to time this thing. And I've never in my career see somebody actually time this well over the long run. Right when you think you should sell a stock, it goes right back up. Right when you think that you know when to hold them and know when to fold them, you don't. And let me show you that. This is my second slide for you today, how quickly these markets turn around. And I did tell you, I gave you that example last week of how in 2025, coming out of Liberation Day, we had that bottom on the S&P there of under 5,000 points, April 7th, we're down 19%. And 2 days later, within 48 hours, 2 days later, in one single trading day, on April 9th, the market rallied 9.5%, not in a couple of weeks or a couple of months, in a single trading day. And you might not have believed that. You might have said, well, that sounds like a data anomaly. There's no way that that's a consistency in the market. But it is. And you look at this time around, it wasn't just 2 days later. It wasn't just one trading day like last year. But it was about 14 trading days that we turned a 9.5% pullback on the S&P on March 30th into a break-even market by April 14th. And then by April 17th, the S&P is actually up over its record all-time high close, almost 2% now. Absolutely not what people expected. If I would have told you that we were going to go into this Iran conflict, oil was going to spike, we're going to have crude oil spiking well over 100 a barrel, and at the same time, the S&P would be almost 2% over its record all-time high close, you would have laughed me out of the room. You would have never believed it. But again, the market tells you where things are going. So you ask yourself the question, why? Is this a Fuguzi, a Wazi? Because this is the next narrative coming now, is the media is going to tell you, well, yeah, we recovered the losses, but it's a dead cat bounce. We're going to go back. We're going to slip back to that 63.50 level. And I don't know. I don't have a crystal ball except for this one on the fake one on the shelf here. So who knows for sure? It could happen. We could slip back a little bit. But the long-term trajectory is all going to be based on the math equation, earnings times price. It's that simple. And so as long as the companies are coming out with strong earnings, which it certainly seems like they are, and actually FactSet, which is the main tracker of earnings data on the S&P, they actually were surprised to the upside too, and they came out and they said, well, we thought it was going to be about $350 in earnings. We're going to revise that up now to $370. And that could even be conservative. And so you start looking at where the future direction of interest rates are going. Interest rates are going lower over time, maybe not on a quarter-to-quarter or month-by-month basis right this second, but over time, interest rates are trending lower. And at the same time, earnings are trending up. Those two factors together point to a higher S&P level over the long run. And the thing that I've been consistently surprised by is just how quickly it happens. So directionally, we've told you we thought the S&P would hit 7,700. I don't know when we hit that. And if we hit it too soon, and the earnings can't necessarily support that in the short run, we are going to have a pullback. We're going to have a correction. Absolutely could happen. So don't be alarmed by that. You could go through a calendar year like 2026. We had a 9.5% pullback. We could have a 5% again. We could have a 20. We could have a 10. But the odds are likely in our favor that the S&P is going to be up double digits a year from now. In fact, when you have this many consecutive days of the market up like it has been, I think it's been about 21 consecutive days now that the S&P has been rallying. When you have an environment like that, it tends to point to the idea that over the long run, over the next 12 months, for example, S&P is up double digits. And I think that's exactly where the earnings point to. It's not a Fuguzi. It's not a Wazi. It's not going to be like all these people on CNBC saying, hey, we're done with the Iran thing, or we're done with the news on the tariff conflict. Remember, they're going to go pick a new story. They're going to pick a new doom and gloom reason. And I'm just warning you today, just like I've told you in the past, that never, ever, 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 ever is the news story the actual reason why the market's down? Because the story came out yesterday. Remember, markets care about the future. Investors care about what's coming, not about what happened in the past. And so it's not different. And so, again, if you're new with us, hopefully you're starting to pick up on this idea that over the long run, the stock market will go up. And it all just comes down to a goals-based plan. So do we manage risk at Stenger Family Office? Of course. Of course we manage risk. And if you're going into retirement, we start to build the stockpile of cash. We start to build your cash reserves. And the goal is not to bat 1,000. The goal is not to go buy you a buffered product or an annuity or some sort of high-risky bond or something like that. The goal is to keep it safe in cash. Why? Because you need liquidity. You need to be able to pull money when you're retired quickly and turn it into spending money if you need it. The other thing, too, is the more yield that you're trying to target, and a lot of these structured products out there that I hear about today, and a lot of these alternative investments and private credit and buffered ETFs and all the rest of it, they promise you a higher yield. And if there's one thing we've learned in 45 years of doing this is what? The higher the yield, the higher the risk. And so there's no free lunch here. So when you think about your financial plan getting into retirement and you think about, all right, I've got a $2 million or $3 million or $5 million portfolio or whatever the number might be, we just want to say, let's take 3 to 5 years of living expenses right off the bat, and let's truly keep that money safe. Let's not go risk it. Let's not put it in a product that promises 6-7% return. Let's get it in something truly safe. That's the absolute key. And then on the other side of the equation, let's get the growth money really growing, because I've seen people for years now mess up the math of their portfolio where they go into the safe side, they take too much risk, and then that money isn't ultimately safe when they're going through a downturn. It still goes down. All those annuity products, those buffered products, those structured investments, the alternative investments, they go down just like any other investment when the market's down, and that money isn't really safe. Then on the other side of the equation, you go into the stock side, and if you start saying, hey, I'm going to keep the stock side really safe, I'm going to go buy these really safe dividend payers. Well, it's not bad to have dividend payers. It's not bad to have dividend aristocrats that are raising their dividends, but you have to have growth in the stock side, because at the same time, there's no such thing as a safe stock. Just like a company on the bookshelf here, Walgreens, which was one of our biggest clients for years until they eventually here just went private, taken private by a private equity firm. Well, what happened there? Well, they weren't really safe. It's an equity. Equities are not safe. And so you just have to be careful of the mix that you have. It's all just math. You can't get around the math of the portfolio. You've got to keep your safe money safe. You've got to keep your growth money truly growing. And we've told you before, we think you should have a slight overweight towards growth investments on the stock side and a slight underweight towards value, especially when we start having better interest rate environment in the future. And you don't want to fight the Fed. That's the last piece of this, is don't fight the Fed. And so the only thing that would give me pause, and this is where we could end our show today, the only thing that may give me pause is if the Fed does decide they're going to get hawkish. I don't see that coming. I don't think that that's in the realm of possibilities to get massive rate hikes. But part of the reason why we didn't put our S&P target this year at 9,000, like some places on Wall Street, is we were not convinced that the S&P, or rather the Fed, was going to cut interest rates. And that's certainly been the case, especially now that this Iran conflict is broken. It does not look like we are going to get rate cuts. And so to get to 9,000, at least in short order, that will not happen unless you get significant moves on interest rates. So as long as we keep trudging along, we don't get massive spikes in interest rates, and things are basically status quo with the Fed, I think we're going to still hit that 7,700 target. So we'll see how long it takes us. If it goes quickly, we're going to have a pullback. If it takes till the end of the year, like I think it's going to, then we're right in line. The market is not going to be a Fugazi at 7,700, just like it's not at 7,000 today, just like it wasn't when we did our S&P 6,000 show. I believe that was November of 24, if I'm remembering correctly. That was just almost about 2 years ago now when the S&P hit 6,000. But you're going to start to see these new all-time highs pick up even faster, which is going to feel like a Fugazi. It's going to feel like it's not real, because you're going to see us go from 7,000 to 8,000 on the S&P. But percentage-wise, it's actually easier to go from 7 to 8,000 than it was to go from 6 to 7, just like it was from going from 3 to 6. And that's exactly what the market's done over time. So just stay on your plan here. There is going to be worse news coming at some point. I still tend to think that we've got some chop ahead. But despite all that, you cannot time it. You can't trade it. You just have to stay on your plan, keep owning equities, own the best companies, and over time, you're going to see the S&P hit 8,000, 9,000, 10,000 as long as the earnings keep up. Thanks so much for being on episode 219. Before we go, don't forget to register for Investor Day. We received a ton of signups after last week's show, and we are getting very, very close to capacity now. I'm telling you, this thing is probably going to be full. It's only April. It's not till October 8th and 9th. But make sure you get on. If you were thinking about coming up for Investor Day, we are going to be full. My guess is the next month or so, month and a half. We are considering we may send out the last mailing invite just to make sure everybody saw it, and then it's going to be full. So watching the show every week, you've got insider access to all these events. That's why you have to subscribe and share it with your friends and family. But make sure you register for Investor Day, October 8th and 9th. Thank you so much for being here. We'll see you next time.